And you're going to have a chance to hear more from him, as well as three other very distinguished economists, Jackson Takach, John Newton, and Barr. I'm going to introduce each of them before they make their individual comments, and then we'll end up with all of them back here on stage, I promise you, but some of them are going to watch from different angles so that the stage doesn't feel all that crowded while they're up. So first off is Jackson. He's the Chief Economist and Vice President of Strategy, Research, and Analytics at Farmer Mac. He's a Kentucky native with strong ties to agriculture that began while growing up in the rural town of Scottsville. He joined the Farmer Mac team in 2005 and has worked in strategy, research, credit, and underwriting departments. Jackson is someone who you probably see because he's the lead author on and the creator of The Feed, which is Farmer Mac's quarterly publication on the agricultural sector. He regularly presents to lenders, producers, and industry experts throughout the year. Please welcome Jackson Takach.
Sara, thank you very much. It's a pleasure. Thank you. Well, I guess I drew the short straw or the long straw. I'm not sure which one I drew, but I get to go first on this distinguished panel of ag economists. You know, I work for a company called Farmer Mac, and we're a secondary market for ag lending, food supply chain lending, rural infrastructure. We really focus on ag mortgages. That's one of our primary focuses as a secondary market. So I think it makes a lot of sense for me to sort of stick to ag credit markets. That's what I really wanted to discuss with you guys today, sort of talk about current lending conditions, and Seth sets the stage beautifully for talking about how the ag economy really blends into lending conditions and credit conditions on the farm and in ag and rural banking throughout the country. So I'll start there, really. It's a pretty narrow intersection. When you think about the Venn diagram of agricultural economic conditions and lending conditions, it's not a perfect circle, but it's pretty close. And when I look at ag net farm income, so net cash farm income, and I overlay that with increases in farm debt, there tends to be a lot of correlation between the two series. So farmers and agribusinesses will use capital from lenders to fuel growth in the farm, and then when there are times that the two things sort of go counter to each other, when you've got declining farm incomes, there can be an additional source of capital come from ag lenders, and the farmers, ranchers, rural Americans may replace some of that income with additional capital. So when you see big spikes in farm income, you'll also see sort of dips in total farm debt. So when farmers have a lot of cash, right, they may replace some of that balance sheet lending with borrowed debt, right? So there can be this like offsetting. When you have a lot of cash, less debt. When you have less cash, you borrow a little bit more. So that tells me that as we start to transition out of a maybe a high income environment, a high revenue environment for farmers and ranchers, you might see additional demand coming from the credit side. So I expect to see some additional demand coming for both real estate debt, so that's where Farmer Mac is probably focused more on how ag lenders are deploying real estate capital, but also on the lending side as costs have increased, production credit is also increasing. So for machinery and operating debt, we see increased demand coming from both of those things. Now the farm debt's up when I look at total absolute level of farm debt, but relative to the level of income, so debt to EBITDA, which is earnings before income, taxes, and capital expenditures, it's actually fairly manageable, right? So this is the blue line is the absolute level of debt relative to farm earnings. It's about 3 times. So we borrow about 3 times as much as we're earning on the farm. We haven't peaked out to where the 1980s have gone, but when I display relative to interest expense, so interest expense relative to earnings, we see a much lower level, right? So from both an absolute debt level as well as an interest expense level relative to the earnings on the farm, it's much more manageable than we've experienced in past contractions in the agricultural economy. Back in the 1980s, you'll see that tall spike in the orange line, about 30 cents out of every farm dollar that was earned by farming, ranching families and businesses was eaten up by interest expense. That's a lot of your earnings to be taken over by interest expense. You can't reinvest that in the business. It's much more difficult to take that sort of income levels if it's all being gobbled up in the form of debt costs. Today we're at something more like 13, 14 cents. So much more manageable than we were in the 1980s, but we've seen it increase as debt's increased as well as interest expense, so interest rates as they have increased. Speaking of interest rates, so the average interest rate on the farm has increased considerably in the last 2 years. So The Federal Reserve has been in a tightening cycle, trying to address some of the concerns about inflation, excess GDP growth, economic growth out there. So, well, that has led to a direct impact on farming and ranching operations as operating costs have increased dramatically with the higher interest rate environment. So you see that orange line there, that's the average interest rate on operating debt. Much smaller increase or smaller increase in the real estate side. It's harder for the real estate to react immediately to higher interest rates because people tend to borrow against their real estate for longer terms, right? So at Farmer Mac, we see up to 30 years. A lot of farm credits will lend up to 30 years. So it just takes a longer time for interest rates to creep through on the real estate side. It's an almost immediate hit in the operating side. So that hit effectively 22, 23 it's been higher, and even in 24 it's been higher still. But when you look at how the market's pricing the expectations from the Fed, we're looking at a Fed cut this week. So that, if you look at that bar, that's the expected level of the Fed funds rate. The markets are betting that the Fed funds rate is going to fall pretty dramatically over the next 24 months. So that's an immediate relief valve for production credit. So as that goes down, so does the cost of production credit, almost 1 for 1. And we see that over the course of the next 24 months, there's an expectation of almost 200 basis points of cuts in the short-term interest rate. So that's a little bit of good news. I'm trying to find some good news, right, in sort of how the ag economy and the credit cycles are merging here. And I think we're going to see some relief in interest rate expense for that production credit here in the next 24 months, we'll say. It's about a 24-month cycle. If you look at the loan performance, so how are banks performing, how are loans performing, and the health of the banking sector as well as the farm credit system institutions, so far it's been pretty good. When you look at late pays on agricultural credit loans, either real estate or operating, the total amount that are past due more than 90 days is historically low. That makes sense given we just went through a pretty solid period of high revenue on the farm and solid profit margin and profit taking in the ag sector. So as as times are good, you start to see people repay that debt, the late pays are very low, and then we start to turn that around as the credit cycle and the ag economic cycles start to change. It's about a 2-year delay though, right? So although we see some really low numbers on this chart, it takes about 12 to 24 months before the banking sector starts to be affected by conditions in the agricultural economy. So we're returning to normal, starting to see that rate tick up, the late pay rate tick up. It's going to take 12 to 24 months for that to be fully realized. So we're kind of in the first or second inning of the ag credit cycle as it starts to turn back to maybe something closer to historical averages. But I will say, I think lenders are pretty healthy when I look at bank balance sheets, when I look at farm credit balance sheets, average capital levels. Everything's looking pretty good as we start to go into maybe inning 3 and 4 of an economic cycle change and contraction. Overall, I'll just make a couple more points and then I'll turn it over to our next distinguished panelist. I think we're tightening, but credit demand may pick up as a result of that. So look out for additional demand. If you're a lender in the room, you're probably seeing that come through your balance sheets. We see it through Kansas City Fed's data, as well as call report data. That demand is picking up. The financial statements will start to reflect the stress in the ag economy, but it's a delayed reaction. So it's going to be 24, 25 financial statements that are going to really affect or reflect the challenges in 23 and 24. So there's this 24-month delay. Rates are going to come down. They are going to come down. It's going to happen in the short end faster than the long end, and it couldn't happen a minute too soon. Starting this week, we might see some relief, and that means the next production cycle, so in the renewal season, farmers may get that benefit of a slightly lower operating debt level, and that's going to take a few more years, and it's going to get lower and lower as those interest rates come back down. I also just want to point out that liquidity is probably going to be the number one thing that we talk about over the next 24 months. It's going to be a premium. Liquidity and working capital can provide time, and they can provide opportunity, right, for farmers, ranchers, rural Americans, as well as banks. So the more working capital, dry powder you have, the more you can withstand a lower price cycle or disruption to, let's say, shipping along the Mississippi. The more dry powder you have, the easier it is to delay effects of those things, and it's true of the banking sector as well. And right now, capital levels and working capital overall are pretty healthy, coming off of 2 healthy years in the ag cycle. And again, it's going to be a premium heading into 24, 25, and 26 as those conditions start to affect the lending sectors. And I welcome further discussion on the intersection of all the ag economic cycles and the credit cycles when we get to the full panel. Thanks, Sara.
Thanks, Jackson. And that is a good segue into make sure you're starting to enter your questions on Slido for all of our panelists, because we'll have a very robust discussion when we get everybody having a chance to share their comments. Our next panelist was just right over here in the corner, but he's that way now. There he is. You might have noticed on some of our preliminary materials that we had invited to this discussion the chief economist of the Senate Ag Committee Republicans, Dr. John Newton, and that's what he was until September 11th. And he had called and said, gosh, you know, I understand I'm going to be making a job change. Would you still like to have me? And I'm like, absolutely. And he has taken an exciting new job. He's now the executive head of Terrain, which some of you may have heard is an exclusive market intelligence platform provided by our friends Farm Credit Associations. Terrain is designed to supply that industry-leading agricultural market perspectives and analysis to help the association's customers to make informed business decisions for their farm and ranch operations. And I know that John is going to do a great job in this new role where he's going to be responsible for both short and long-term strategic direction. And he brings to this position 2 decades of experience on Capitol Hill, working as a chief economist, American Farm Bureau Federation, and having a very distinguished career on the Hill. So please welcome Dr. John Newton.
Thank you, Sarah. All right. You know, I've worked with Jackson for a number of years. I did not know you were a Kentucky native. How are you hiding that from me? You probably know I'm a Kentucky native by the twang that I have in my voice. Can we get this slide up here, the green one that I see? Can you show that? So I started a new job, and I fly to Tahoe this afternoon. And one of the things I have to do, which I'm really upset about, is I have to get a new headshot. I've been living with that thing for about 10 years. My daughter makes fun of me. She says, Dad, you're all gray, your beard's white now. So when I update my headshot this week, it's gonna be noticeably grayer. But I have been doing this kind of work for 20 years. I'm excited to join the Farm Credit family. I'll tell you, my years at Farm Bureau, I did a lot of meetings for the Farm Credit system, for all the Farm Credit banks. And I would walk into those rooms and I couldn't tell if I was at a Farm Credit meeting or a Farm Bureau meeting. So it is like family. I feel like I'm coming back home to where I was at AFBF a few years ago. And one of the things that Senator Bozeman, you know, most recently when I was on the Ag Committee, we like to talk about is that farming is the backbone of rural America. If you get outside of any city of any size, the contribution of food and agriculture to the rural economies is huge. And if you look at this map, you know, right down the middle of the country, the contribution of agriculture to the economy, 40%, 30%, where all of you are from, where all of you work, your contribution to the farm economy represents 20% of our economic output and 15% of the jobs in this country. These numbers come from Feeding the Economy. They update this study every year on National Ag Day. John Bodie at the Corn Refiners puts this information together. It's incredibly helpful to know what the economic contribution is for agriculture in rural America. And what's the backbone of agriculture? Oh, this is different than that. Okay, well, I can get back on it. Agriculture has entered a downturn, and you've heard it from Seth, you've heard it from everybody this morning. This is the state level change in net farm income from 2022 to 2023. So the USDA Farm Income Report, where's Spiro? Your report a week and a half ago, everybody was paying attention to the 2024 number, but this was also the first time where we got to see 2023 net cash income numbers at the state level. And as you can see, in crop country, there's a lot of red. Now in the cattle country, Texas, Nebraska, Oklahoma, Kansas, and even in the South Dakota, their year-over-year change in net farm income is not as significant as what you see outside of cattle country. You look in the Corn Belt, you're looking at 20, 30, 40% year-over-year declines in net farm income. And net farm income is an aggregate, very, very broad overall measure of farm profitability. We've entered a downturn in the farm economy. There's no question about it. The 2024 numbers that were released confirm that. I think you can dive a little bit deeper into those numbers, which I'll do in a second here, because I think there's a lot more stresses than what that farm income forecast shows. How many people have heard the phrase, the market takes the stairs up and the elevator down? How many people have heard that? The farm economy, these past few years, took the elevator both ways, right? If you look at inflation-adjusted net farm income and inflation-adjusted net cash income, from 2020 to 2022 was the second largest increase of all time. From 2022 to 2024 is the largest increase we've ever seen, or largest decline in net cash farm income in history over the last 2 years. So the farm economy, it accelerated, but where we are today is a 22%, 27% decline in net farm income. And I think the decline that we've seen in the farm economy is the reason why there were so many farmers on Capitol Hill. I was cleaning out my office last week, but there are a lot of people doing fly-ins, talking about the stresses in farm country, talking about the declines. And, you know, we were seeing farmers were bringing their balance sheets up to Capitol Hill to show folks how much I'm losing per acre when they were doing their fly-ins last week. It's very real what's happening to agriculture and to rural America, and Seth highlighted all of that in his excellent remarks. But when you dive in to the farm income numbers, when you look below the aggregate net farm income measure, you start to see something different. At the commodity level, net cash farm income for wheat producers expected to be down 50%. Soybeans, you're looking at a 40% decline in overall profitability. Corn, 38% decline. Cotton, 28% decline. Other crops, including rice, grain, sorghum, etc., are looking at a greater than 20% decline in their farm profitability year over year. If you look at other livestock, that's the reason why USDA revised their net farm income forecast up. It was earlier projected to be $116 billion. They raised it, the second largest increase that we've seen over the last decade, revision in net farm income on the back of a healthier outlook for the livestock sector. The challenge is, where's the president of pork producers? Where are you? As you mentioned this morning, when you look at the hog sector, it's up 11%. That's off the ground because it was a pretty bad year last year. It's the second lowest over the last 15 years when you adjust for inflation. So even though it looks better, it's not very good at all. So a lot of sectors in agriculture are feeling the pressure right now. And there have been a lot of conversation about the Farm Bill, getting the Farm Bill over the finish line. And when the ag groups were coming in last week, and you're starting to hear more about it now, is the call for some, and Senator Moran mentioned it this morning, the call for some sort of ad hoc package, some sort of supplemental package to help shore up the farm economy, help shore up farm income. And the reason for that is the Farm Bill programs that farmers and ranchers depend on, the ARC programs, your PLC programs, for what's happening today, they are not going to get any relief until 2026. So your farmers are seeing a 50% decline in their income, and they're not going to get any support from these risk management programs until fiscal year 2026. That's why people want to see a Farm Bill get over the finish line. We can update those risk management tools. My former colleagues are working very hard to do that, but that's also why you're hearing the calls for we need some ad hoc support, because the assistance they're going to get for declines that occurred last year and are occurring now is not really going to come for a few years. So there's a lot of pressure in farm country before the relief comes from their income support programs. And what's happening moving forward? Seth talked about input costs. Jackson talked about interest rates going down. Spiro's folks also put out the first forecast for 2025 cost of production for major field crops. And for every single major field crop, outside of cotton, USDA is projecting higher input costs in 2025. And you said corn is below $4 a bushel, and costs are going to be higher next year. That's not a recipe for success. I don't know how many farmers can pencil that out if input costs stay high, stay sticky, and commodity prices keep falling. We had a farmer from Minnesota come in and said she had to grow a record crop this year just to break even. Her farm has never done it, but they had to have a record crop just to break even. So that's the dynamic in farm country. That's why risk management, marketing decisions are so very important. Where's Tom Zacharias? I was talking to him this morning. I was like, is there a way that farmers could have locked in through crop insurance a December price a year and a half ago, 2 years ago? I bet a lot of farmers would have liked to. Look where those corn prices, this is the December corn futures contract. Look where those were 2 years ago. A lot of folks would have liked to lock in $6 a bushel corn. That's not where we are today. I just checked the board, corn's at $4.10 a bushel. Where's your support levels? The national average break even based on Spiro's data is about $4.78. So we're below the break even for corn right now. The spring crop insurance guarantees $4.66. All right. If you have an 85% coverage level, you have to see a pretty sharp decline for that to trigger. We're way below that. The Ark County guarantees $4.17 a bushel after you take into consideration the 86% trigger on that. We're below that. The WASDE has it at $4.10, and the PLC support is $4.01. So now is the time where marketing and risk management is so critically important in a low price environment. Take advantage of the opportunities that you have when they're there. It's tough. For a farmer, if you're going to sell a futures, you got to have a margin account. You got to have an access to credit. It's very, very difficult. But there are a whole suite of risk management tools that are available. Crop insurance is a big one. I know that the farm credits across the country sell crop insurance. And that's why I'm happy in this new role to be a resource for the farm credit banks, for our customers, because farm credit is there in the good times and the bad times, right? And I just went and I was looking at the data. When we had the last downturn in the farm economy, the farm credit system continued lending for operating loans, for real estate loans. They increased their holdings of farm debt by over 40% during the last downturn in the farm economy. That was 3 times larger than the increase in debt held by any other creditor in agriculture. So the farm credit's there. It's a resource. They can help you with crop insurance. They can help you with marketing. They can help you with understanding the farm bill when we get it done. I'm so glad to be a part of this family, be a part of Terrain, and I look forward to working with all of you in the future, and I look forward to all the questions that you guys may have on the panel. So thank you so much for the opportunity to be here, and if you want to scan that, that'll take you to the new website. Thank you.
Not bad for just starting a new job. Our next panelist is Kanlaya Barr. Kanlaya is Director of Corporate Economics at John Deere. In her current role, Kanlaya manages a global team of economists and oversees all facets of economic analysis, including agriculture and construction fundamentals, as well as short and long-range industry forecasts for John Deere. Since joining Deere over a decade ago, Barr has held various roles, including forecast analyst, manager of forecast analytics, agricultural economist, and global economist. And prior to joining Deere, Kanlaya had roles with multiple financial organizations. She received her doctorate degree in agricultural economics and a master's degree in accounting from Iowa State University. Go Cyclones. Welcome, Kanlaya, up to the stage.
It's been a good season for us so far. The only game that really matters was the game that happened a couple of weeks ago for us. So, thank you again for the invitation to be with this panel here. We're looking forward to the discussion with the esteemed panelists that we have here. You have heard a lot about what happened in the ag economy. So I thought what I would like to share is to kind of think back a little bit in terms of in terms of when we come into this downturn in agriculture, what do farmers respond, what have been in the past, and how do we kind of looking into how can we set ourselves for success when the time comes, as Seth has mentioned, that right now we have seen some dryness around the country and also some dryness in South America as well. So weather continues to play a big role in what is happening in the next 12 to 15 months. I don't have any slides to share, but I want to kind of talk us through a little bit. I would argue that over the last 2 decades, we have gone through a couple of agricultural cycles Those are big cycles. The first one happened during the biofuel, and we had significant demand coming in from China. And then what happened after that? From 2013, we had a really bad drought in the US. And after that, that demand that we had has been stabilized. We had that 15 billion gallons of ethanol, and also demand from China has stabilized as well. We had 4 years of that really good weather around the world, and then that's when we see prices decline significantly. During that time, also remember that when price dropped about 50% or 60% from the peak in 2013, the land value continued to hold its value. The value decreased between that time to the trough of the previous cycle was down about 15%. And ever since then, in this previous cycle, I would argue that the cycle started when we had that demand coming in from China after African swine fever, and we continue to see multiple challenging in-weather events around the world. Interracial in the US, we had the drought in the CIS country. We also had the drought in Canada, and also we topped that off with the Ukraine and Russian war. During that time when crop prices increased, we also see the farmland value increase by about 40% from 2020. So therefore, yes, that is something that's gonna help our producers be able to buffer the impact of this low price environment. The second piece is when it comes to farm practices and how farmers can adjust or making the adjustment in their practices and their inputs, how do they think through that? Well, I would say if you think about the 5 key inputs here, machineries, seeds, fertilizers, chemical, and also land rent. These 5 inputs account for over 70% of farmers' input cost. And the way farmers are gonna make the adjustment, we can learn from the previous cycle, right? You think about some of these inputs gonna be a little bit more sticky than others. Think about machinery. You can probably do away from not having machinery this year. You used to trade 4 or 5 machines every year. Maybe this time you do about 3 machines to be able to make your capital, your machinery invest go a little bit further. We're gonna see some more volatility there. But there are other inputs, such as when you think about fertilizers, farmers know if you reduce the application for fertilizer, you're gonna see that negative yield impact. So, but at the same time, affordability has becoming an issue as well. And Seth has shown those already. Yes, we see N coming down, nitrogen is coming down, potash's price is coming down, but the price for phosphate continue to be pretty tight, pretty high because of the tight supply. So affordability is gonna continue to be on top of farmers' mind in terms of fertilizers. And there are some other inputs. You think about seeds and also chemicals. Those are a little bit stickier. Farmers don't want to do away with reducing those, but maybe we'll see some trading down in those inputs from generic to generic brands to save on costs as well. Of all of the inputs, the one that is stickier, probably the stickiest one, is probably going to be land rent. And as you see right now, a lot of the farmland is entering into that 3 years agreement. So you're probably not going to see that rent adjustment coming up this year, but maybe next year. So all in all, yes, there's some adjustment that our producers can make, and that's going to help them becoming more profitable. And there are some of them that's going to continue to be a high input cost that farmers are going to see that squeeze in margin. The part that I also want to focus on, which many of our panelists have already talked about, is yes, those are adjustments that farmers can make in this tough time. But also the difference between this time and the last cycle is the interest rate. Yes, the market talks about maybe we'll see 25 basis point drop, maybe we'll see 50 basis point drops. But the point is, it is still a very high interest rate. Many farmers gonna have, a couple of years ago, when the price is good, many producers are able to fund their operations with the loan, with the money that they're making. But right now, with the crop prices that we're seeing, many producers the capital is running out. They are making tough choices as well. Think about there would be some land that it might not be profitable to bring into production this year. Or there might be some crop rotations that farmers are gonna have to make choices. Are we gonna continue to do corn and soybeans, or we have to switch over to soy over soy because it's cheaper to plant soybeans and corn? Things like that's gonna continue to be decisions that farmers have to make as we go into the next year. But at the same time, there's also opportunities. I believe that the opportunities for farmers to lean into practices that allow them to reduce costs and becoming more profitable as well during this time. Think about technology. Think about, for example, in our machines, we also have operation center that you might have seen in the sponsor video earlier. Those are platforms that allows farmers to track the workforce. As an example, when I talk to our product guys, they tell me all the things that our tractors, our combines can do. But as an economist, I remember a couple of probably the most simplest example. Our tractors, our combines, our sprayers, they can track the amount of input has been sprayed. You know how long it's gonna take. You know when you need to refill those tanks. So as a result, you know, it helps your operation becoming more efficient. It lowers the cost. It helps improve the margin. So those are the things that farmers could be also leaning into this environment as well. So, and finally, what I would like to, in terms of difficulties, it also comes with opportunities where this is a time for policymakers, for financial institutions, for agribusiness to come together to make sure that we help providing that flexibility that our farmers need, for farmers to be thriving and also be able to provide the food and also resources that we all greatly depend on. So with that, thank you so much, and I'm looking forward to our discussion today. Thank you. All right.
I invite everybody to come back up for the panel, and we'll go ahead and kick off here. Grab a seat, any seat. All right, thank you. Okay, here we go. Thanks to all of you again for those great opening remarks. A little echo there. So, Galena, you mentioned some of the tactical things that farmers could be doing to weather these tougher times ahead. And as we saw in our first slide of question, there are a lot of folks who are realists, pessimists, however you want to classify it. They're reading the same numbers that you all presented and saying, we're not going to jump out of this anytime real soon. 2025 was perhaps looking as an equally precarious time. From a policy standpoint, and Seth, I know you're not a policymaker, you're the numbers guy, but just thinking about what the leaders in this room who are going to be advocating not only for a new farm bill, but they're going to be saying, do something to help in this rocky time. What would be some of the things that you think they should be advocating for in addition to a farm bill? And Jackson, I'll maybe start with you.
Well, so I mentioned credit support being incredibly important. It's a capital-intensive business. Everybody in this room knows how important capital is, access to capital. So I think about times like this, what can we do? It's really being proactive, both from a lending perspective, so can regulators make sure that the banking institutions and the farm credit system institutions have access to all the capital that they need, all the support that they need, and all the understanding that they need to continue to be able to lend capital in a more challenging environment. And also that capital is patient and has good, strong supports at the regulatory and policy levels too. So I think really coming in, stepping in and supporting the lenders who will actively support the communities, actively support the businesses that you're all members of and work with throughout your businesses and day-to-day lives. To me, that's incredibly important to kind of keep that access to capital flowing during increasingly tight margins and increasingly tighter time. Like I say, I can't be more emphatic about the access to working capital and liquidity in surviving difficult and challenging times. If you don't have that can dry up a business so fast, and all the policy supports that we can get to maintain access to capital in a more challenging environment is incredibly and increasingly important.
Anyone else want to jump in on that? John?
I mean, I know you said don't talk about the Farm Bill, but I would go back to the Farm Bill. I think we heard earlier, we're going to have a $42.5 billion ag trade deficit in fiscal year 2025. The Farm Bill has dollars available to invest in MAP and F&D funding so we can go out and find and develop new markets so that we can reverse this negative trade balance that we have. Another thing that people need, they need to be able to rely on their university, their extension service. put money in ag research. Where's Bart and Joe back there? Bart does all the heavy lifting at Texas A&M. I don't know what Joe does, but putting money into our land grants, getting extension economists out there. I went to the Ohio State University. There were a lot of extension economists at Ohio State when I was there. There aren't very many anymore. We need to put more money back in those universities so that farmers can go to their land grants, go to their universities, and get access to good information on how to weather this downturn.
Yeah, I think it's important that when you think about biofuel, you know, that could be a part of this bigger picture of decarbonization, right? Biofuel has proven to have lower CI score than fossil fuel, so it's a better fuel. But these billions of dollars of investment in the industry is depending on the policy uncertainties. Having certainties in that policy, having a long-term policy that is help supporting biofuel, supporting our demand in the longer term for our farmers, I think that would be something that would be very welcoming in the farming communities.
Just so we would have some sort of planning scenario would be good, right? Seth, one of the questions that came in, and thank you for all, there's lots of questions flowing here. How long do you expect this current downward trend to last, and what variable will have the biggest impact on the length of time?
You know, so I almost hesitate to show those cycles because it implies that you have 3 years of plenty and 5 years of lean times. I almost hate to show that. I have no idea how long this lasts because we see these shocks come up externally in the rest of the world or domestically that cause these shocks, that cause prices to jump. So, you know, the answer is, I don't know. I will say that I think that this is, absent a shock, these kind of narrow margins, maybe not this narrow, but these kind of narrow margins are more regular than the boom years. You just don't know when the year that comes along where you're going to make that money that you're going to have to try and live on for a few more seasons. So the answer is, I don't know. It doesn't seem to me that there's an obvious shock on the horizon. When I look at the, let's get really in the weeds and talk about the option spread. That's almost an indicator of, does the market think we're in any trouble? Is there a risk of prices going higher? Pretty sanguine about the opportunity for a jump in prices and a single shock to push us back into a high price environment.
Can I say
Go
one
ahead.
thing? They used to call them black swan events. And I think in agriculture, we've had so many black swan events that I think they're just swans now.
Thanks, John. One of the other questions that came in is, we did talk about the fact that, you know, we're seeing this downturn in agricultural exports and an uptick in imports, primarily more on fruits and vegetables side. But one of our questioners wants to know, how cheap does cheap grain have to get to attract export markets in a much bigger way? Thoughts on that?
Well, I think over the last couple months, we've seen price doing the lifting when it comes to things like corn, right? We're doing a little bit more trade to Mexico and some other things. So you're seeing price do some of the lifting there. But when you think overall in terms of how does China's economy look, what does demand look like within China, it's hard to push on that string per se. I think there are some commodities, rice, where we aren't seeing the price action yet kind of combined to see those prices move. But economic principles work. As those corn prices fall, we've seen some folks pick up some bargain. But got a lot of corn this year with the second biggest crop.
I'll also tie that back to the price of Brazil. So what's the relative price of soybeans and corn in the U.S. to the relative price in Brazil? And we've seen that relationship start to right size too. So as our prices gotten lower and the Brazilian prices have gotten lower, all of a sudden U.S. looks like maybe a better deal than it did 6 months ago, which is a good sign to see that maybe the global prices are starting to clear a little bit. So maybe it doesn't have to go materially lower for us to sort of see that price support kick in and see the demand kick in.
And are there other markets for corn that could be emerging as we start to build up? I mean, I'm sure this is not a short-term solution for anybody, but in addition to Canada and Mexico, I mean, what are the other possibilities?
I think the problem is in the next 2 to 4 years, there isn't an obvious market substitute for China, unfortunately. I think as an economist, I think, and that comes to, I was up on the Hill to a meeting with some folks on the Ways and Means Committee who were surprised that we have a trade surplus with China when it comes to agriculture, right? We have a trade surplus with them. Doesn't mean it's comfortable, Doesn't mean it's a great trading relationship, but it is also, there's not an obvious alternative in the very near term to that marketplace.
And Seth, even going longer term, doesn't China try to also be self-sufficient in many of their crops?
I think they say this a lot. I'm not sure they can do it. Okay. All right. I mean, this is an open-ended question, but at the same time, we have no. I'm an economist. I like transparent markets. I like markets you can see into. We see less into China than we had before through a combination of China closing off things, state-owned enterprises. Our actual transparency into the Chinese market has diminished, not increased over the last couple of years.
Kanlaya, this is a question for you. Where do you see technology playing a role in not only, as you mentioned, the ability to potentially reduce input costs, but also adding to that efficiency, adding to that data set, so that when people do get compensated for losses or potentially government payments in the future, how does that all factor into our overall ability to be more efficient?
Absolutely. I think, and Undersecretary Bonnie talked about a lot of that in detail as well. Maybe I'll think of it in many ways. First of all, technologies allow you to have that data. What do you do with that data, providing you insight? For example, if you know how much longer your sprayer is going to take to empty, you already have that solution waiting for you at the end of the field, as opposed to you having to wait 2 or 3 hours for the solution to come. You can fill it up like that. So that reduces costs, that reduces the diesel costs and things like that. So that can immediately reduce that. The second part of that is it's also reducing some of the labor costs as well. As we think about autonomous tractor that we have, allow you to take that labor, we talked about this morning in one of the sessions that talks about how difficult it is to find labor. So any of those technology allow you to also have less labor needs as well. And the third piece of that, and that Undersecretary Bonnie talked about this also, that data aggregation allows you to have that traceability. So with that, allow you to open up to this new revenue stream that is coming in from the Smart Ag. If you are able to track your data, that you don't have the no-till in this piece of land, you have the decreasing in fertilizer in this piece of land, all of those can come in. It can calculate the CI score for you. So then that way, when you bring your crops to the elevator, you are able to get maybe perhaps down the road here, get more return from that crops because it has all of this data that's already available for you from the technology that we have in our machines. So those are some of the things that really, everything's help in this kind of environment.
Thank you. John, I want to turn to the Farm Bill for a little bit. We had Senator Moran this morning saying he was more optimistic about things happening on the Farm Bill front, primarily from a conversation that he had with Senator Stabenow. But it was not exactly, a specific plan. It was more of a, yay, there's some things that we can do. It might be an extension plus some other things. What do you think is kind of that art of the possible that he might have been referencing now, short of full passage?
Well, I'll tell you, all 4 corners of the Ag Committee, all 4 staffs, they all work very well together. So I think, did the mic go? No, there it goes. When there's a deal that's reached among the principals, when Senator Stabenow, Senator Bozeman, by the end of the year.
So we'll keep an eye on what's next there with the Farm Bill. I know you've been working really hard on trying to get past the finish line, as have the 4 corners. A lot of questions are coming in on not only biofuels, but UCO, SAF. We talked about this a little bit last night, Seth. Let's start with just looking big picture, and anybody can pitch in here on this. I know that there's been this excitement over sustainable aviation fuel as a new market, and the things that, the places we could go if we could get this all working and the right qualifications, the right tax credits in place. But we're not quite really there yet. So let's talk a little bit, and Seth, maybe starting with you, about what you see as some of the potential and the barriers.
So I think I'd start out with, and this goes back to some of the earlier questions in terms of, I'm not a policymaker, so I'm always hesitant to talk about what policies. So let's talk about something in what needs to happen in a technical sense. And I think what needs to happen on the biofuel side in a technical sense is the productivity gains of U.S. farmers have to be able to be reflected in those CI scores in a way that they aren't today. I think a lot of times the modeling, and I don't want to get into the weeds here too much, but I'll give you an example. A lot of times the modeling fails to reflect the reality of the way things are today. A couple of examples would be in some of the SAF discussion, sustainable aviation fuel. There are portions of Brazilian corn, second crop corn production, which receives a 0 GHG score. A 0 GHG score. It has no carbon impact whatsoever. And yet, U.S. corn has a positive score, so it's causing, so it has a worse GHG emissions just naturally, and then to it gets added indirect land use that's occurring in Brazil. So the Brazilian corn gets a 0, and yet U.S. corn is penalized for indirect land use in Brazil. Okay, that is on its face a non-economically reasonable outcome. Okay, so I think that there are challenges like this. And then UCO. I think, for instance, the carbon intensity score for which UCO gets imagines that UCO in the United States and elsewhere in the world. Oh. Or you. All right. So that UCO envisions that this UCO was just not being used for anything historically. And we know that for at least 15 years that UCO has been being used for something. And so when you pull increasing the amounts of UCO out of whatever it was being used for to produce biodiesel, something is going to backfill that UCO use. That's here, that's in a place like China, and that changes the dynamics of that scoring. So I think that from a biofuel perspective, there's an opportunity, but we need to get this scoring correct, and it needs to reflect the productivity gains here in the United States. And I think about some of the safety guidelines that people think that they are putting on the system that work the opposite of what they think it does. The more you draw UCO into the system, the more you're backfilling it with something else, and that something else may not be as environmentally friendly as you think it is.
Anybody else want to talk about SAF and potential?
Well, I'll just weigh in on sort of the weird intersections of policy goals, supply and demand, and sometimes what we want out of the policy goals and what we get out of supply and demand without some level of certainty in the markets themselves. It's very difficult, essentially, to plan for a market and support a market and make that market be there. We learned that in ethanol back in 2007, 8, 9, 10 era, right? So there were a lot of plants that were built very suddenly. A lot of people were doing the tax credit analysis. We built huge amounts of supply very quickly, and then we had maybe too much supply very quickly, and that caused a lot of stress. And so I think that it's very difficult when you got a new biofuel. It's very exciting. I like the opportunity. I think it offers a great offtake of some of this excess supply of grains, particularly when I think about soybean crush and I think about some of the things we can do with SAF. I think it's great, but it's also very difficult to plan for that supply and demand, get that equilibrium just right without quite a bit of back and forth and that disruption there.
I want to add one point on the SAF. It all came out of the Inflation Reduction Act. The Inflation Reduction Act was written through a budget process called reconciliation. We never had a single hearing. You never had expert advice like what Seth just dropped on SAF that could have been incorporated into the process when you write the IRA. The IRA didn't have any Republican input. It didn't have much stakeholder input. So these are some of the unintended consequences when we don't do what we're supposed to do, and that is get the stakeholders involved at the beginning, get the experts involved at the beginning when we're writing policy.
And just a quick note, I think we have to get this right because I know there's some questions talk about the EV. Think about today, 15 billion gallons of ethanol goes into passenger vehicle. And as we have more of the shift in passenger vehicle toward electric vehicle or hybrid, those demand for ethanol domestically is going to over time declining. So opportunities for aviation fuel is big, not just the US, it's around the world as well. In the US alone, you see 35 billion gallons of SAF, of aviation fuel that is potential, and the market is even much bigger outside of the US. So I think it is important that, yes, we think this might be far down the road, but the challenge that we have from electric vehicle and from hybrid to take away some of those demand for ethanol, I think those are not far away. So we have to figure out how can we be able to work on this issue together.
Good point. Do you think we've reached peak EV?
I'm thinking of buying one. My husband does, at least. Yeah, but it's hard. The range, just like a lot of consumers, the range anxiety does continue to be, with the family of 5, it's hard to have stranded with kids. You don't want to do that.
Especially out in the middle of North Dakota or someplace in the wintertime, that would not be good. So a couple other questions just about the role of government payments have come in, and I'm going to kind of divide this up a little bit, and John, I'll start with you. We had a huge infusion of government payments during not only the Trump administration and then the COVID payments, and we're talking about both presidential candidates having a tariff policy that we probably can't pin down right away, but using that as a negotiating tactic and potentially keeping all the ones on there. And one of the first questions I hear from farmers is, well, will we just get government bailouts again to make up for either tariff losses or ad hoc disaster? Is that the way you think policymakers are looking at this, is let's just spend more money to fill some gaps? Or should farmers have perhaps a more rude awareness of the fact that maybe those next payments won't be in the cards?
I said easy questions. Holy smokes, that was kind of a hard question.
John?
Here's what I'll say. If you go back to 2019, the amount of ad hoc support that's been delivered to agriculture, it's probably close to $80, $90 billion at this point. The amount of support that was provided by traditional farm bill programs was about $10 or $11 billion. So through all those black swan events, the farm bill didn't deliver the type of support it should have, and we had to lean on ad hoc disaster support. And a great example of this is when China put tariffs on soybeans, the soybean price declined, but the reference price for soybeans was $8.40. It never triggered. So what good is that reference price if when your number one buyer puts a tariff on it, the safety net's not there to help them? So that's where the importance of the Farm Bill, modernizing these safety nets, can help farmers weather any type of black swan event, not just the one you're talking about now. We don't know what's going to happen in the future, but we do know if we invest in the risk management tools, you make crop insurance more affordable, you increase the education around the crop insurance programs, farmers will be protected the next time there's an ad hoc event that they can't anticipate, or a disaster event.
And Jackson, you provided some of probably the best news of the afternoon, looking ahead at interest rate cuts, So one positive going forward. What else, how quickly do you anticipate we're going to be looking at this glide path, or will we start and stop a little bit? What's kind of the future outlook on that from your perspective?
Yeah, it's a hard thing to predict exactly what the Federal Reserve is going to do. I always like to look at what's the relative level of current interest rates to inflation, and that tells me about where I think neutral policy is. So I'm looking at inflation rates around 2 to 2.5, let's say 2.5 to 3%. I think the Fed, as well as everyone in this room, feels comfortable with interest rates about a point higher than current levels of inflation. So that tells me neutral interest rates are somewhere between 3.5 to 4%, right? Just in round numbers. We're about 200 basis points higher than that. So I would look for maybe some adjustments in that glide path toward, again, looking at the market, what the market's saying. I kind of tend to agree with right now. Earlier this year, back in January, they were pricing, I think, 700 basis points of rate cut, like more than you could actually have, like basically going back to zero in interest rate policy. And I think that was a bit aggressive. The market, I think, was overestimating the Fed's interest in cutting interest rates. But I think where we are today is probably a fairly priced given the current levels of inflation. Now, if that holds and we start to bring that policy rate back closer to the neutral rate of inflation adjusted returns for investors, we're looking at somewhere between 150 and 200 basis points in cuts over the next 12 months. right? But that's, again, best guess. It's really hard. If I could predict exactly what the Fed was going to do, I probably would not be sitting in front of you today. I'd like to think that I would, but maybe I'd be flying around on my PJ somewhere, off to a warm spot in the Pacific.
Find that beach. So as we wrap up here, and thank you for all the questions. There's been several good ones that have come in. I'm sorry we haven't gotten to all of them, but one of the questions that I'd like to end with is just the optimism I always have for the future with the enthusiasm that young farmers do bring to our industry and younger entrants. Tell us from your perspective what you see as something you can share right now with someone who wants to enter the business. Is it, here's some things to watch, here's some timing to wait. What is the message on the ag economic front that we can share with younger producers today? And Kanlaya, I'll start with you.
Well, I think it's interesting of now we see the agricultural has not only been the way we have done in the past, but also the level of technologies that has coming in. So I think having that, be able to looking into increasing productivities and be able to leverage that technologies and be able to do that with technology that a lot of young people are familiar with the apps on your phone, with things like that. I think that's providing a lot of familiarity to our younger farmers as well. So I know it's tough with the capital investment is big and it's in terms of interest rate as we are today, but I hope Jackson is right. A couple of years from now, things are normalizing a little bit with the rates is coming down. I think that will open up more opportunities for younger folks to get into the market.
I'll second technology. I think it's incredibly exciting. I hear a lot of younger folks that I talk to getting excited about the promise of maybe AI actually delivering the baby that big data was, supposed to be. We talk about big data for years, but maybe AI gives us that capability to understand it and do more with it. So excited about that. I also think, this next generation inherits a lot of wealth, a lot of opportunity from family members. So we look at the transition of older farming generation into a younger farming generation. There's a lot of opportunity to modernize some of these farms, carry on some of these traditions, but also look for ways to do things a little bit differently. Which I think is incredibly exciting. And then the last thing I'll say, I'm sorry, I'm taking up like 3 things. I shouldn't do 3 things.
Well, you're
right?
leaving us nothing. You're leaving us the crumbs down here
Well,
on this end.
I'll just say that it's an incredibly exciting industry, and we think about the why people do what they do in the food and agricultural community. We feed the world, and it's literally something that I feel good about every single day that I go to work, and I know that a lot of young farmers and producers out there feel the same way.
I'm trying to think of something to add
Sorry,
after that.
I just kept going.
I'll add, let's see. So I think technology is very interesting, as you've all said, from the standpoint also of, as we think about, and I always think about things in a reg standpoint as well, the technology which is going to allow you to comply with regs and service markets. I think also that this cuts both ways, is the consumer interest in their food does provide some, we always think about there's some bad things that come with it, there's some good things that come with it, and maybe it allows some folks to be new and innovative and deliver to what a subset of consumers want.
I was going to say innovation. Why don't you just you took mine.
That's all right. You can say it again. You can say it more eloquently. How about that?
Look, farmers, they're engineers, they're plant scientists, but greatest of all, they're innovators. They weather these challenges. I had the opportunity to go to the AFBF YFNR conference in Omaha this year. All these young farmers thinking of new and innovative ways to grow their business, reach into new markets, do new things that maybe their parents didn't do. So I think the future of ag is very, very bright for the young, beginning, and small farmers. But there's a real challenge on the horizon next year when we get to the Tax Cut and Jobs Act. And estate taxes and stepped-up basis, that poses a real risk to the ability for young farmers to take over the family operation when they lose something like stepped-up basis or 129 exchanges. So I think that's going to be a big fight next Congress is what do we do on tax policy, because that has major implications for young farmers.
Well, thank you again. Ladies and gentlemen, wasn't this an excellent panel and presentations from each of our guests?